Okay, Bill, are you ready?
I am ready.
All right. 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hofstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I speak with Bill Gebhardt, founder of 10 Dynamics. Bill spent the better part of his career as a discretionary energies trader with roles at Koch Industries, Merrill Lynch, Deutsche Bank, and Trailstone. In May 2020, he struck out on his own to co-found 10 Dynamics. Given Bill's fundamental and discretionary background, it may come as a surprise that 10 Dynamics runs a fully systematic process. This dichotomy serves as the foundation for much of our conversation, where Bill provides insight into where and how his discretionary background informs the systematic process, both from a signal and a risk management perspective. We discuss the types of signals 10 Dynamics incorporates into their process, how their risk management system is designed to reflect Bill's experience managing discretionary traders, and how they've designed their operational risk management to allow them to trade intraday with a small team. Please enjoy my conversation with Bill Gebhardt. Bill, welcome to the podcast. Excited to have you here. Coming at a very popular trend-following strategy, very popular in the last couple of years, but from a completely unique discretionary trader angle. So I think this is going to bring an interesting new light to what I think most listeners would say is a well-trodden topic. Hopefully, I think we're going to get some exciting new stuff here. So thank you for joining me. Really appreciate you being here.
Thanks, Corey. Great to be here.
So I disclosed a little bit about your background, but maybe you can tell us a little bit about how you got into the industry, your background as a discretionary energies trader, and how you ultimately decided to make the switch to running 10 Dynamics as a fully systematic shop.
Sure. Well, if I start, I guess, as far back as my undergrad, I was a chemical engineering major in undergrad. And my last year, or coming up to last year of my degree, I needed to get a part-time job, and I got a job at a brokerage, stock brokerage, to help one of the brokers just do sort of the, I guess, clerking type stuff that they needed back then. And my first day on the job was October 19th, 1987. So I literally started on the day of the stock market crash, which was interesting because I wasn't as emotional about it as everybody else was, because I wasn't really that familiar with finance, but it was such an amazing event, I think, that happened, and it really got me intrigued in finance. And when I looked to graduate as a chemical engineer and looked at what chemical engineers did compared to what finance people were doing, it just seemed like, well, that was a lot more fun. So I switched my interest into finance and ended up getting a master's degree in finance, and then worked in Chicago on the CBOE as a clerk for a floor trader on the options exchange, which again was a fantastic experience. And for those who are younger, you'll never get the chance to be in an open outcry pit, which I think is one of the really unique and instructive experiences of my life in terms of watching how complete chaos can turn into order, that's what the floor was all about. So did that for a few years and ended up eventually going back to get a PhD in finance because I felt like I needed a bit more education, and did my PhD at Cornell. When I finished that and debated about going into academia, I ended up getting hired at an energy trading company, worked for Koch Energy, and that business evolved, ended up doing a joint venture with a utility called Energy Koch. And from there, that got acquired by a bank, got acquired by Merrill Lynch, and spent most of my career doing energy trading and managing prop trading desk and prop traders, primarily all in Europe. So I ended up in Europe with a joint venture with Energy Koch in about 2001, and I've pretty much stayed my whole career in Europe. Their energy, and I think probably most commodities in general, are very fundamentally based in their approach. So they tend to have fundamental models, forecasting demand and supply, and discretionary trading off the back of those models. And And so initially I got into kind of the fundamental forecasting side of things, and eventually ended up managing a trading desk covering a lot of energy products in Europe, and did that at a couple banks eventually. And then we basically spun out of a bank and started a private equity funded energy trading company in about 2013. And I was one of the original partners there, and built an energy trading business with a large team of prop discretionary traders. And that was really my focus for quite a few years. And over that time, though, I had, because of my PhD and quantitative background, I developed some tools that I used for my own trading, and actually shared with some of the people on the desk a bit too, to try to give indications of when fundamental type ideas might or might not be right timing. And people talk a lot about that, about using price signals for timing with fundamental signals. And I've been improving and working on those models for quite a while. And eventually we ended up hiring a systematic team at my last company. And it was really interesting because they were very successful, and they were successful in ways that I hadn't seen anyone else be successful in the past in terms of being pure systematic in energy. Because I thought, given how the relationships are very dynamic and things are always changing, that it would be difficult to do, but actually it was definitely possible and achievable. And when the business that I was in decided to kind of shift gears in their focus, and I was wondering what I was going to do, I decided to basically leave and see if I could use the tools that I built over my career and put them into a full-blown system and apply them to a much wider range of markets than I could follow as a discretionary trader. And that's what I did. So that started about just when COVID started, was when we started the company, and we've been kind of going ever since. And now we're 3 years in on a live track record, and things have been going pretty well.
Well, there's a lot to unpack there. And again, as I said at the intro, the idea of having someone who's come from such a strong fundamental perspective to translate that into a fully systematic perspective, I think there's going to be a lot of interesting crossovers. But one of the things I want to start with is actually on the risk side, because in our pre-call, you mentioned to me that the vast majority of the disasters that you've seen in your career have largely related to optimization, or maybe over optimization. I wanted to start this conversation maybe with some examples that you could provide of those cases and how that has ultimately informed some of your early design decisions at 10 Dynamics, again, moving into this fully systematic process.
Yeah, I mean, we can go all the way back to when I was a PhD student. So I was a PhD student kind of in the middle of my time there at Cornell, and that's when you had the long-term capital disaster. And that was obviously, as you can imagine, was a big deal in academia because there were some pretty high-profile academics involved in that problem. And optimization at the end of the day relies on sort of a belief in stable statistical relationships, right? You have to have something stable to be optimizing towards, otherwise you're not really achieving anything. And you had long-term capital management was getting famous because they were sort of proving the counter argument to efficient markets. And then all of a sudden, not only was it not an arbitrage they were capturing, that was brought down the entire financial system. So it was used by a lot of, I guess, market efficiency type people as an example of how the markets truly are efficient. But it was a good example to be skeptical about what looks like potentially stable relationships in markets that can end up being highly unstable. And from there, when I moved over to energy, one of the things you learn, again, in commodities and definitely in energy, is that things can be quite unstable, relationships unstable, particularly correlations. The correlation is one of the things that I became very skeptical of, just because in commodity markets, you get substitution effects. So you can have a small change in prices that will cross a substitution boundary, and basically your correlation can go from high to zero in a moment. And so because of that, you look at what people in those markets use, they are almost all fundamental models where they use switching models basically to regime switch between different substitution effects rather than using kind of statistical correlation-based models. That sort of fit with my, I guess, belief that correlations were risky to rely on amongst other relationships. And then when I was at one of the banks that I worked for pre-2008, they had lots of businesses that were these kind of correlation-driven, highly optimized models that were up to that point working very successfully. And then 2008 happened. And a lot of those things that were hedges based on the correlation turned out to be leveraged bets at the end of the day. And you saw things that were either minor or major blow-ups along the way. And And that just, again, reinforced my concerns over optimization. And I just started to feel like, well, what's better, assuming that you know something or assuming you don't know anything? Where's your base? What's your Bayesian prior if you don't know anything? It's sort of, well, you equal weight everything. And so that's kind of how I arrived. The approach that we take is that we have to bias the model in any one way or another. We have to be really certain that we have a handle on things being stable. Otherwise, you sort of tilt things in one way, and then the next thing you know, you have an event come along and it ends up switching everything around. So those were some of the things that over time colored my views a bit.
Contra to some of the leading trends in the systematic space today, when you were starting to build out your program, you didn't really want to let the computer figure out what works by just looking at the data. You wanted to sort of replicate what you would do as a trader. And I think that's a very interesting and novel approach, and again, relies on your background of being a discretionary trader. But I do find it interesting that it ultimately seemed to boil down into what is effectively a trend following approach. I'm curious, why do you think that was the case?
I think it actually was the case for me, and maybe for people like me, in the sense that I tend to be a visual learner. So I've always liked graphs and charts and stuff. And when you get exposed to this industry and you see a graph, the first thing you see is some massive trend on some chart where it moves for years. And you think, gosh, if you only catch one or two of those, you can make a career out of that. And so I think it was really looking at charts and seeing these long trends that really come off long dated timeframes. And again, that naive, I guess we're all naive at some point when you start something, and coming in from an engineering background, I used to look at those charts without knowing anything about random walks or anything like that and thinking, geez, how hard can it be to predict this stuff? It's got to be pretty straightforward. So I sort of decided to crack the code, or try to crack the code, and how to capture those big trends. And you can contrast that with, I've been kind of fortunate in my career to work with some very good traders who had a very different approach. And they were, I would call them numeric in their views, and they would never look at charts, not even really interested in charts, but very numbers based. And so for people who are numbers based, what you tend to do is you see a number and you think that number is high or low based on some whatever intuition or fundamental model or whatever. And so people who are numeric, what you see from them is they gravitate a lot towards mean reverting or fundamental strategies, and they can be very successful doing that too. So I think for me, it's not that trend following is better or worse than anything else. It just fits my mental model. I think when I look at how I learn versus that very price based, I say I'm the opposite. I look at prices and it doesn't say anything to me whether it's high or low. I don't know how to assess whether the price is high or low. I always thought, well, if it's low, it can keep going lower. And so I ended up pursuing basically models that would try to predict that type of behavior.
Can you talk a little bit about the frequencies at which your trend models trade and how you came to choose those frequencies?
Mm-hmm. It's a little bit what I just spoke about. I was really focused on these long-term structural shifts where markets would double or triple over time and then reverse and go back down. And so I was naturally attracted to long-term timeframes. And really then it became a question of, well, how long is too slow? And you get to timeframes where you're trading for your future generations. And so I stopped, focused mostly on weekly and slightly longer timeframes, never really did anything with monthly timeframes. And then it becomes a question of, okay, well, how quick can you be? If you're going to start with a long-term time frame, work your way slower, how fast can you go? And one thing that's definitely true, the market behavior does change. As much as we like to think that our philosophy is that market behavior is the same on all frequencies, once you get below a certain frequency, market behavior changes quite a bit. Jumps become a lot more important. You get mean reversion. That becomes a lot more of an influence, and trading costs go up. And so there is a point at which I think trend following really doesn't work or even make sense anymore. And for us, we went down and we kind of stopped at about a 30-minute time frame. It's about as low as we go in our analysis. And then from there, we're looking at how many time frames make sense to trade within that bracket. And you can kind of divide it up. And eventually, if you divide it too small, you end up with very little difference between each one of the time frames. So across that different slices, we sort of worked out that like 10 to 15 different time frames make sense. And that's where we focused our analysis.
In our pre-call, you mentioned that when you look at contribution analysis, the returns that you have generated largely come from the long-term trend positioning. but that a lot of the risk management in the program comes from the short-term positioning and readjustment from those short-term trends. How do you think about this interplay, and how do you think about balancing these signals to strike the right mix between return opportunity versus risk management?
If you look at the return for any unit of risk by time frame, what we see in our model is the longer the time frames, the higher the return on risk. So even when you normalize on the risk of that time frame, the higher time frames are more successful and more trendy, I guess you'd say, than the shorter term time frames. And so that would make you think, well, then we should just focus really on the long term time frames. And if you do that, you can see that if you sort of bucket the signals by time frame, then yeah, for sure, you get the highest returns per unit risk out on the longer term time frames. But the unique thing, I guess, about the shorter term timeframes is that, let's say you look at maybe something that on a weekly basis and it's been trending for a while. If you zoom in on it, obviously you'll see counter trend moves, and those counter trend moves can look very big on shorter term timeframes. So if you have a model that can capture those shorter term trends, what it effectively does, if you just think about two time frames, you have a long term time frame and a short term time frame, is that short term time frame hedges the long term time frame right when it's in a drawdown. So even if the expected return on that short-term signal is low, as long as it cuts the drawdown on the long-term signal, so the short-term signal will effectively absorb the loss. And then as it comes back, even if the net return on that signal is zero, it still will have reduced your drawdown long-term signal. You get this nice balance of the return, you're capturing these structural movements in the longer-term charts, but at the same time, you're controlling your drawdowns using the short-term trends that occur within every move, basically.
As you increase that speed, typically transaction costs become a larger percentage of the total return as well. How do you think about that trade-off? Again, with the idea of those short-term signals can be very beneficial from the risk management perspective, but they may be ultimately costlier to execute and therefore a further drag on performance.
Yeah, I mean, it's definitely true. And we have a pretty good price impact model that, uses spreads and vol adjusted spreads and stuff to account for that. And as I mentioned, the risk adjusted returns on those short term timeframes does decline as you get quicker and quicker. So it really just becomes a question of, well, at what point does the hedge benefit gets outweighed by the trading costs? And that fits into kind of where we stop with our analysis at that sort of 30 to 60 minute time frame. And there's a point at which it becomes marginal, and then there's a point at which it becomes detrimental. And so that's kind of the guiding, I guess, principle that we used in terms of how fast we want the model to be, because we think we just can't capture, or maybe there aren't even capturable trends on those shorter term timeframes. It's more of a mean reverting game anyway. So I think it's important to know or be able to estimate what those trading costs are and look at your net performance on each time frame. And as long as it's contributory, then it's probably going to provide a decent hedge benefit for the overall model.
One of the unique features you mentioned in our pre-call was that your models try to incorporate the amount of time it takes a market to perform a certain action, sort of as this means of, I think the phrase you used was capturing whether psychology has shifted. I was hoping you could talk a little bit about why this is an important feature for you to include, and maybe how you think about including it mechanically, but particularly through that lens of your background as a discretionary trader.
When you look just purely at the time aspect of a given trend, and it's almost a tautology, but if you look at an uptrend and you count every day that the market was going up, and then you count every day that the market was going down, you have more up days than down days in an uptrend, and vice versa in a downtrend. That's sort of regardless of the size of each one of those steps. So it's kind of the 2 steps forward, 1 step back. And that is one way of looking at how prices move, but it also fits, well, you can say, is it any different than looking at price? And it is, because for everyone who's been in the market, you've experienced these events, and we've had one recently, where you might have a very sudden trend reversal. So the market's been trending in a particular direction, and you have this sudden trend reversal. And it usually comes out of the blue from some sort of shock that was unexpected, or drives, if you're short, it drives some kind of short covering rally because it's something that comes out of people's expectations. So if you look at the behavior of those events, well, how are you going to grade that behavior? They can be really fast, so the momentum can be real high. So it's going to say, well, maybe psychology shift because the speed is increased in the opposite direction of the trend. A lot of times we look at how linear a movement is. Like, does it go in a particular direction steadily every day, or is it kind of back and forth, back and forth? So those shocks tend to be very linear as well. So again, it looks like it's a potential psychology change. It may, if you're a traditional kind of breakout trader, oftentimes they break key levels and they can be bigger than the previous move that was preceding them. And then you see that event and then you think, oh, okay, everything's changed. And next thing you know, well, it gets reversed steadily over time and you're back into the original trend. If you think of recent examples, COVID is a primary example of this. October of 87 was another one where you just had this incredible move down and then you slowly reversed up from there. The only way we can identify that it really hasn't changed the psychology is to say, well, actually, what it did, it happened in a very short period of time. People haven't had time to adjust to this different mindset, or maybe it's just a shock and then people are going to go back to thinking what they were thinking before. And so it's like an independent measure that may line up with what price is doing, may not. And it definitely has value in times when it's saying something different than what your kind of price behaviors signals might say.
Anyone who runs a trend following program ultimately runs into the choice of whether they want their signals to be truncated in any way. So you can sort of run these continuous signals, or it's very common for people to run binary signals. And you mentioned that you run binary signals rather than that more continuous distribution. And I think the quote you used in our pre-call was that you didn't want to be fooled by false precision. And my pushback to that might be binary signals, on the other hand, would be incredibly imprecise when trends are weak, right? When you have very little trend signal, all of a sudden you're getting a big +1 or a big -1 indicating a stronger trend than really exists. How do you balance the robustness versus accuracy trade-off when you think about measuring trends?
Well, I mean, we think about like, why did we prefer the binary signals in the first place? And there are a lot of signals. This lines up with some equity fundamental signals, some other signals that I think people are probably familiar with, that if you bucket your signal into deciles and then you look at kind of the expected return for the given deciles, what you see is almost an S-shaped pattern. A lot of signals have this almost mean reverting quality at the extremes. So you can have the 10th decile having lower returns on the upside than, say, the 7th decile. So at the times, if you're going to use a distribution type signal, actually, when it's the strongest, it's not nearly as strong as you think. So it's not even that it's not accurate. It's actually has potential to predict the other way. So, and then if you break it down, you take that same signal and you break it down into quartiles, what you find is actually there's really no statistical difference between the two quartiles. So then you're stuck with kind of a binary signal anyway. So yeah, you end up kind of working your way back into a binary signal and saying, well, this is the most robust. But you're right, they're subject to flip-flopping back and forth, right? If you're close to whatever the boundary is that you're using to create the signal. So that's why we use several different signals and combine them. So we have 10 dynamics is the company name because we have 10 signals that we combine and we add those up. So for any given binary, it's true, it can flip around a lot. But when you start adding lots of binaries together and then you add across different time frames, what you actually end up back with is a distribution. But that distribution, if you look at, that is much more predictive in terms of the top deciles and the bottom deciles being more significant than the middle and than the center. And so you turn signals that have these sort of S-shaped predictive characteristics into something that does actually have the ability to forecast at the extremes.
So I want to switch from talking about the signal side of the equation to the risk management side, which is just as potentially even more important in any sort of systematic or discretionary trading program. And again, in our pre-call, you mentioned that you wanted to design your risk system to mimic some of your experience in managing discretionary prop traders. So hoping you could expand on that a bit, maybe talk about how you think about risk budgets, both at the portfolio level and the position level.
Yeah, I mean, one of the really important things I think for a lot of discretionary traders is being and knowing the difference between when you have a good idea and when you don't. And a good discretionary trader, when they have something that they really know is an edge and they're able to fully deploy their capital, that's sort of the definition of being a good discretionary trader. When those events happen, you should make a lot of money. But what you see, the difference between the really great discretionary traders and the ones that aren't as good is that what happens in the interim periods when you actually don't have a great edge and you don't have a lot of information that you think is something that is different from what the crowd thinks. And what you find is for discretionary traders, because they tend to like to trade, it's hard for them to not trade in the same sort of size and deploy the same amount of risk, even when they're kind of sure versus when they're totally certain. So what will happen is those traders will have an event where they had the right view and they make a lot of money. And then they spend the rest of the year, whatever it is, trading sort of lukewarm types of ideas with a lot of risk. And they end up giving back and having a big drawdown and losing a significant portion of what they made. I have seen in the past a few notable examples of traders who would come in and literally not make a trade for weeks or even months. And then they'll get an event where they'll have some information that they think gives them an edge, and they'll trade their full risk and they'll make their year in a short period of time. And then that's all they do. And that's a thing that translates, I guess, a little bit into systems, and where I guess the ideal discretionary trader would have zero risk most of the time and then 100% risk the rest of the time. For us, what we do is we try to allow the system, even at the asset level, to scale within fixed risk budget. What that means for us is that we'll have an equal risk budget for every asset that we trade. So we're basically equalizing the risk across the different assets. And then within that, you'll have a position based on, we call it the model confidence. It's effectively how strong the signal is. And we run at about 40% of max position, either long or short on average. Obviously, that can be up to 100% deployment on that particular asset, and it can be zero. So that's at the asset level. What that means, though, because again, we don't really flex the portfolio risk up and down, it's just this equal distribution of risk across the assets. It means the portfolio itself has quite significant risk scaling that happens naturally just from the signals. So we run at about 40% our max risk, 45% of our max risk on average. We can be as low as 20% on the portfolio. So we can be quite lowly deployed. And that's when we look at all the assets we trade and the model is just not really strongly positioned in any asset. And then you can have times where a lot of things are trending and our deployment will be quite high and we'll have a lot of risk deployed relative to the average. We can look at, because I know other funds do this, well, they don't like idle risk, right? So they want to force the model to be fully deployed. So if we scale up, when the model has a low deployment relative to its risk budget, we can scale it up and scale it down. And we find is that hurts returns because it effectively means you're putting more capital at risk when your model is forecasting less strong movements, and you don't increase your risk when the model is forecasting high movements. So by equalizing everything, you kind of hurt the performance, both in terms of the return and in terms of the drawdown control. So I don't know how many other systematic people do it that way, but we definitely think it's something that contributes to the return.
Anyone who has designed a systematic strategy that uses an ensemble of signals will be well aware of the core problem that even when these signals are positively correlated, it's unlikely, just statistically, that they're all going to point in the same direction at the same time, which can often mean you're never using your full risk budget that you might allocate to a particular instrument. Curious how you tackle this problem.
Well, it's kind of what we just spoke about. We'd call it a feature rather than a problem. You're right. It's difficult for the model on any given asset to be 100% deployed. When you look at how often each asset is at 100% deployment within its risk budget, it's probably less than 10% of the time, I'd say. And when you look at the portfolio as a whole, we reach max risk maybe once or twice a year. So the risk scaling that we get, it does seem to, because the returns are so much higher at the moment, you're deploying most risk, it does seem to make up for that effect of the fact that you're underdeployed when the risk is low. So yeah, we actually think the fact that you're not always 100% convinced and that kind of stuff, that's really a feature of the model.
In our pre-call, you mentioned that in your back testing, if you looked at independent 5-year periods since 1990, there would have been very little alpha decay in your program. And this is a pretty significant departure from what we see in more traditional trend followers who candidly have seen their alpha arguably decay every 5 years since the 1990s, particularly struggling in the 2010s. Fingers crossed the 2020s are better. But why do you think this is the case? Is it something unique about the markets that you're trading? Maybe a little bit more of a focus on European energy markets? Is it the frequency and types of signals you're using, or maybe something about the way you manage risk?
To be clear, like when you talk about kind of the 2010s, we don't see, and I guess we're maybe a little bit unique. We use the same model for everything and we don't change the parameters over time or change it across the cross section. So we can look back, and what we do see is a very strong cyclicality in alpha across the entire portfolio. So you do have time periods, and it's not just like 1 year is high and the next year is low. You have 3 or 4 years in a row where really alpha is really strong. And then you have 3 or 4 or 5 years in a row where it's really weak. In the 2010s, even for us, I would say our Sharpe ratio was about 70% of what we consider our average expected Sharpe ratio. But if you look at the period right before it and the period subsequent to that, the Sharpe ratio was above that. And we've seen, going back to the 90s, we've seen several of these alpha cycles. And it's a good question, like how much is it what our model is doing? And one of the things for us anyway, and I don't know, it might be true for other people as well, our return over risk is about double for bull markets. If you consider what's normally a bull market in sort of normal markets, if you look at rates or something, you might think it's the other way around. But as long as you're grading those things equally, we make about double in bull markets than we do in bear markets. And makes sense in markets where you have limited downside and unlimited upside that's probably the case. And if you look at the 2010s, what's unique is during that period of time, you had a large oversupply in a lot of markets because of the financial crisis. So you had large oversupply in a lot of commodities. You had a lot of bear markets. And so when I look at our system during that time period, our system was net short on average across everything. And that's why our performance was a little bit below expectations. Same, you talk about 2020s. Well, right now, our model is running net short and has run net short for about the last year and a half. When we look around, we see quite a lot of bear markets and not many bull markets, with the exception of, but even I think I mentioned to you earlier that we run it on single name equities. And here we have the equity market that's been performing amazingly and hitting new highs, but you can really, in our model, you can really see the narrowness of that rally because our model is slightly net short, despite the trends in the indices being very bullish. There's a lot of underlying trends in individual names that are negative. So we look at what is that bull bear market cyclicality? Well, that's driven by macroeconomic events. And I think that's partly what's happening right now. So we don't anticipate that there'll be, well, hopefully that there won't be alpha decay to come. We're actually hoping that we get back to where there's some stronger bull markets across the large variety of things that we look at. And the other thing, it's interesting, I do think that there is structure, time series structure in the alpha in our strategy and maybe in all trend following strategies. I don't know. We haven't decided to try to capture that yet because it sort of gets us disturbingly close to optimization if we do that. But there is, in my view, there is clear structure in alpha and the time series of alpha over the last 20, 25 years.
I want to talk about some of the differentiated features of your program for a moment. And some of that is in the markets that you trade. And you mentioned it in your last answer there, trading these individual securities. And this is a point of debate among a lot of trend followers as to whether individual stocks in particular represent a new and novel subset of diversifying markets to be traded, or whether trending properties within stocks are largely overwhelmed by the idiosyncratic jump risk that they can experience. Would love your thoughts on that, because again, a lot of trend followers tend to say you need a diversified basket of stocks to get more of those trending properties. It's more in the risk factor beta. And then there's plenty of people who say, no, you can point to a couple of real outlier stocks and see the trend opportunity very clearly. And it's a large debate. So would love your thoughts.
Yeah, I think it's a little bit like the question about time frame. In this case, I think it's market cap or trading volume, right? That as you go smaller, I think you do become very driven by news and jumps and things like that. And where I would question whether things like Apple or Nvidia or anything like that or anything other than just the normal trending market. And so we focus our model on the large cap space. And within the space, there are industries that work really well. And there are some old industries where, again, it turns out to just be about news. And so we restrict it to industries that are developing and things like technology and works well in energy and that kind of stuff. So there is certainly, from our point of view, some stock selection that's possible using trend following. The other thing, it's interesting what you get with the trend following. If you apply it to a basket and you add up the signals on the basket, you tend to get a better risk factor signal than if you do applying it just to the risk factor. So take beta, for instance. If we just back out the net long or net short position and use that as a signal to trade, which is kind of the sum of what the model is doing across everything, that tends to be a bit better than trading the index directly. Now, that's been true up to this point. In the last several months, that's not the case, where the indices have been strongly performing in the system. And if you look at the components, you would be flat, basically. And to us, that's just, again, kind of a diversification of strategy and why we include them, because we do get diversity by looking at them as well. But I do think the intuition that there is a limit, and it really has to be kind of big, well-traded stocks for trend following to have any sort of independence from just what the market is doing.
Another set of markets that you've introduced that might be unique compared to other trend followers is a focus on the European commodity markets, which are typically underrepresented among most systematic macro traders. And you believe that these are actually some of the best trending markets. And I'd love for you to expand on that view.
There's this balance, in my view. There's this balance between liquidity, kind of the commercial participation in the market, like how many hedgers are there out there really, and also the underlying infrastructure cycle for the production consumption facilities for that market. And energy in particular has a very strong infrastructure cycle. So you have these big cycles of, you end up with oversupplied for years, and then all of a sudden markets get tight, and then that gives the price signal to build new capacity, and the new capacity gets built, and then you go to oversupply again. And this cycle is really what drives these big moves on longer term timeframes. And it's been a regular, energy in particular, you can look at this regular cycle going back as far as you want to look, really. So any market that has that characteristic, I think, lends itself to trend following. The other thing is the liquidity. If you look at the strength or the trendiness of markets by liquidity, you see a really strong inverse relationship. Your most liquid markets tend to be the least trendy on almost any time frame. They take lumber in the US, very liquid, but also very trendy, right? So there's this trade-off between having it be liquid enough to be able to trade it, but also if it has some limits to liquidity, it tends to trend better than other markets. And I don't know what that optimum is necessarily, but I think things like EU energy, and there are some other markets that are a little bit off the beaten path. The key to liquidity is having good commercial participation, right? So in Europe, you have big utilities who are hedging and trading actively. And so the market is deeper than it actually appears on screen. And I think what draws your typical trend following CTA is, how does it look on screen? Where if you know what's going on a little bit more in detail, you might see that actually there might be an OTC market that trades, that has big volume going through it. The dry freight markets are another one where there's liquidity kind of behind the scenes that you don't see. And those markets tend to trend pretty well too. So I'd say EU energy space is one of several areas that are interesting, I think, for people to look if they're willing to do some deep dive into the real underlying fundamentals of what makes those markets operate.
One of the difficulties with shortening timeframes is, and especially if you're shortening timeframes and running a continuous process, is that you run into a number of operational complexities. And this can range from data ingestion to trade execution. And this is something that doesn't translate well into a back test, especially where there can be this conditional relationship between operational issues and market events. Can you talk a little bit about how you set up your operational risk management?
Yeah, absolutely. And I'm happy to be asked about it, because it's one of those things that we never get asked about, really. And investors don't even really focus on it. But you're right, it's so important. And to be honest, we didn't really anticipate or know how important it was going to end up being when we started. I haven't set up a fund that had operational risk like this before, so I didn't really know what I was getting into. And you're just focused on the commercial part of it, right? Let's find something that works. But yeah, the operational, and particularly the more automated you become, the more pressure there is on operational risk. And We just got lucky. My partner, who's responsible for the operational technology side, came up with this idea, kind of one of these out of the blue ideas. And we built it into this system that we're quite proud of. And when people are thinking about this, where we started was we started with a couple principles. The first one was that when in doubt, don't trade. So we thought the most important thing was if there's a problem, just stop trading. Stop trading for that asset or whatever it is, but don't trade. That there's way more risk in doing trades than in not trading. And you can actually test this. So you talk about the difference between back tests and operational risk. So you can say, well, what happens if we aren't able to trade on a given day? Let's say you have a day outage or whatever. How does that affect returns? And for us, we call, your new deal P&L. So that's the P&L that you would get on a given day associated specifically with the trades you just did in that day. So that's how your portfolio did relative to the trading you did on that day. And you look at, okay, well, if we didn't do those deals on a given day, how much does it affect things? And what you see, even in pretty violent market conditions, if you aren't able to trade for a day, yeah, it can have an effect, but it's not really going to be significant on any sort of longer term time frame. So we felt like that was a good principle to start with. The second thing is we decided not to go for kind of a real-time streaming processing setup just because that's harder. It's operationally harder. It's conceptually harder. It's programming harder. And if you run things on a batch basis, you give up some speed. You can't be as quick, but it's much easier to monitor and control. So given that we don't really go below 30 minutes anyway, we felt like we had time to run everything in batch. And so what we do is we run the entire system front to back, runs every 30 minutes across all the assets that we trade, almost as if from scratch, right? So it's a nice, repeatable, and controllable process. So those are kind of the principles we started with. And then the concept that my partner came up with is this idea of the freezer. So we do everything in Python. We're a Python shop. And what's nice about Python is this object-oriented kind of approach. And so within our system, we have all these different objects. We have assets, which we call tickers. We have portfolios, which are made up of tickers. We have accounts. We have brokers. Any kind of element that fits into our system is an object. So for each one of those objects, you know how that object fits into the calculation of whether or not you decide to trade. And for any instance of an object, what we do is we assign a validation state. So we say, is this object valid or not? And the way we determine that is on each one of those batch processes that we run every 30 minutes, every instance of the objects get run through this battery of validation tests. So right now we're over 100 and something tests. And they're things like, well, is there a value missing? Or is the value too high or too low relative to what we should expect? Or we compare it to the most recent value and say, did it change more than we would expect? And so you have all these different criteria that you use to check each one of these objects to make sure that it's valid. If it fails one of these tests, then the object becomes invalid and we put it into what we call the freezer, which is basically just a table in our database. And what that means is that that object cannot contribute to any trading, and any objects which are dependent on it will also not be able to contribute to any trading. So for instance, if you froze a particular account, for some reason an account got frozen, then you wouldn't be able to trade any of the assets that go in that account, but you'd still be able to trade the assets. Let's say you were trading Apple in two accounts and one account was frozen, then you would stop trading Apple just in the one account and you wouldn't stop trading it in the other account. And then what happens when something goes into the freezer, we get notified. So the system has all these notification things set up. So we get notified real time that something is frozen. And then that's a signal for us to go in and look and see if there's a problem and either override it or correct it or whatever it is we need to do. So that's where our human intervention comes in when things go into the freezer. And, we had like one example test that we do. We test for data gaps. We had a big stock split just 2 weeks ago with NVIDIA splitting. So if you hadn't captured that corporate action correctly, you would have walked in on Monday and you would have had a big gap on the open. So our system would capture that on the next batch and would say, hey, there's an unexpected gap in the price. It would put NVIDIA in the freezer and it would stop trading NVIDIA in every account, which we had a position in NVIDIA, and it would notify us, hey, there's a problem. You guys need to have a look at it. And then we can address it. And the really cool thing about the system is once you have that, it just like creates this protective web that covers everything because it has all this interrelationships between all the objects and how the objects contribute to the calculations. And then you can also use it for risk management. So we have different limits for liquidity, and we have limits for VAR, and we have limits for notional limits and things like that. And so part of the testing that we do is around limits. So same thing, you could have an asset that breaches some limit that then gets frozen, flagged by the system. And then we can go in and decide, well, we can have a risk meeting basically and decide, do we want to change the risk for that asset, or do we want to keep it as it is, or do we want to reduce the position? And we can tell the system what to do. It'll automatically scale down the position if that's what we want to do. So I don't know how we managed to get to where we are because it was just like a bolt out of the blue, but it ended up being something that I think is really valuable. And anyone who's doing this should think really hard about those controls because, as you said, as you're trading along, like one of the tests we have is we don't want to trade more than a certain number of times for any given asset because one of the ways things could go wrong is you could trade hundreds of trades for something on a given day, and you don't want that to happen. So you can pretty quickly come up with all the different ways things can go wrong based on the processes that you use to come up with what trades you're making and set a validation test for every one of those events.
One of the potential risks is that in your suite of validation testing, there's just a gap you haven't thought about yet. And that's sort of where ultimately team comes in. And I was hoping you could share some thoughts around team organization and responsibility delegation. To your point, maybe you do have a test around making sure something doesn't trade hundreds of times a day, but while you're not trading high frequency, you are trading at speeds where if someone isn't paying attention and you do have some sort of gap in your validation process, you could end up with some pretty strange portfolio positioning pretty quickly if you were ingesting bad data or a market was shut down that you didn't know about. How do you think about that problem? How do you think about organizing the team?
We're small, so the delegation is all hands on deck effectively. So we have just the two of us who are focused on the day-to-day trading. We're both on deck the whole time. So anything that's happening with the system. So we have obviously all the messaging around when there's a problem. We also have messaging around when there isn't a problem. So we have heartbeats that come through to make sure the processes are running. We have other messages about how things are performed just to make sure that things are running according to the timing and all that kind of stuff. So is it possible that something could slip through? Certainly wouldn't want to say it's not possible, but I think you can get to the point where you're pretty convinced that anything that could happen that would be a big deviation from what happened previously would be caught by the system. And we do have the two of us there, they're watching it all day long and making sure that things are going according to plan.
How do you think about the trade-off of hard-coded rules versus human oversight? You've obviously built out this suite of validation rules, which is very important. I presume continuing to contribute to that suite of rules is a critical function of what you do. Is there a limit to the viability of that suite, or do you think human oversight can fully be replaced at some point?
The analogy I always use with people, and I didn't really have a good perception of this when we started about how people think about full automation and sort of the risks and the fears around that. And I think people's experience has always been that you need to have a human in the machine somewhere because unexpected things can happen. And that's really interesting question and kind of conceptual idea because the analogy we use is, well, people talk about whether it's true or not, I don't know, but that, well, auto driving cars are difficult and still seem to be beyond our abilities at the moment. But we have had the ability to have auto flying planes for a long time because there's far fewer unknowns like humans on the road and stuff, and that we could really have planes without pilots if we wanted to. But the question then is, well, who would actually get on a plane that didn't have a pilot? And I think right now that's probably nobody. So it's a little bit like that with systematic trading. People want to make sure that somebody is at the wheel, if you will, to make sure there is some human oversight. But our view is, for sure, the human oversight should only be used in exceptions. We don't really want any human oversight into actual decision-making around, positions and whether something should be traded or a particular trade should be taken or not, even during times of stress. During COVID was one of the system's best, strongest performing time periods. So I think we want the system to trade the way it's designed to trade. And as long as the inputs that are going into the system are correct and we can validate that those are correct, we really want the human oversight to just come in on an exceptional basis. And when it's something that's being signaled by the system as an exception and outside of its expectations.
Well, Bill, we've come to the end of the episode, and this season I'm asking every guest the same question to finish things off, which is, tell me something that you're currently obsessed with. It could be a show, it could be a new activity, it could be a book, whatever your Roman Empire is today, so to speak. What are you currently obsessed with?
This is pretty far afield, but I've sort of gone down this consciousness rabbit hole. I think that a lot of people are intrigued by and have really gotten fascinated by the ideas of a couple different people in different areas that sort of touch on this idea. And I think one is from a philosophy point of view. You have Bernardo Kastrup, who's done some very good series that are available on YouTube and stuff on analytic idealism as opposed to materialism, which I think is really fascinating. And it ties in closely with my other favorite, which is Donald Hoffman, who's looking at the consequences of game theory and evolution on consciousness. And I think those two things really tie very closely together and have really made me think hard about what we know and what we think we know and the kind of world that we live in. So I think it's, for those who like that kind of stuff, it's fascinating.
Amazing. Thank you so much for joining me today.
Sure. Thank you. I really appreciate it.